Good morning, everybody. As it is 10:30, I will just get started. As anybody who registers will get a copy of the recording anyway. So if anybody's late, they will be able to catch up that way. So today we're going to cover the 60% tax trap. Apologies that we had to reschedule from last week. I had some issues with my throat, which made it difficult to speak, which has been fine since, and I started again this morning. But we shall endeavour, and I'm sure we'll get through it okay. So just before we get started, just a couple of bits of webinar housekeeping. Please stay muted so that everybody can hear rather than being multiple voices. I always have my speakers off until the question and answer period to avoid any feedback loops, so I can't hear you if you start speaking anyway. The recording will be available before the end of the day, same as always, but potentially it'll only be available for a little time. We'll basically review them afterwards to see if there's any compliance issues. That might be too time sensitive to make them shared in a more robust way. Some of our previous webinars are on our YouTube channel, but they could come off at any time if there's a compliance reason to remove them. And as always, the webinar is educational and it shouldn't be taken as personal advice. So before you take any actions based upon it, you should look at your own circumstances and evaluate it individually rather than just follow whatever's said here. So we'll cover the background of income taxation and the 60%, so that you can understand how the 60% tax trap works. And we'll explain exactly how it works. We'll go through some of the maths, or the maths if you're American, and then we'll talk about legal ways to reduce the effect. As always, we'll finish with a Q&A at the end. Feel free to add your questions as we go along. Nobody else can see what you're asking. One of the reasons we use this platform is that people logging in are anonymous, so you don't know who else is available, who else is on the webinar. So a little bit of background about how income tax works. In order to understand the 60% tax trap, you need to understand this. A common misconception, I think surprisingly common, is that people think that if you become a higher rate taxpayer, so you're in the 40% bracket, that you're paying 40% on all of your income, which isn't the case. In the UK, we operate what's called a marginal tax system. So your first X amount earned will be taxed at this rate, then the next amount will be taxed at this rate, then the next amount will be taxed at this rate. So your marginal tax rate is the highest rate. So if you're a higher rate taxpayer, then the top end of your income is being taxed at 40%. Average tax rate is something different, which is how much overall you're paying against your total income, which you calculate by working out what your tax bill was for the year versus what your income was. So it's important to remember that it works in slices in the UK, so you'll get so much tax-free, so much at 20%, so much at 40%, etc., depending on what part of the UK you're in. Scotland is the only bit that's different. It still uses a tiered system, it just uses different rates. So I'm going to do the examples of somebody who lives in England. Well, it's actually England, Wales, and Northern Ireland to begin with. And we'll work through some steps that explain how the tax trap works. So if somebody was earning 100k in England, they have so much tax at their personal allowance, which is 0%, so much at basic rate, which is currently 20%, so much at higher rate, which is 40%, and theoretically so much at additional rate, which is 45%. If we break the 100k up, we'll get 12,570 tax-free. They'll get 37,700 at basic rate. And the remainder will be at higher rate. They won't go into the additional rate. So this means across the year, they'll pay £27,432 in income tax. Their marginal rate is 40%, because that's the highest rate which they're paying. And their average rate for the year was 27.43%, because on their 100,000, they paid £27,432. Now, the tax trap is that as you go over £100,000 in earnings, you lose, for every £2 extra you earn, you lose £1 of your personal allowance, so £1 less taxed at 0%. Some people call this tapering of the personal allowance until eventually personal allowance is completely gone when you reach 125,000 Sorry, just put my mobile on the disturb. When you reach £125,140. So I'll work through the numbers on this. So if somebody was earning £125,140 per year and there was no erosion of the personal allowance, their tax would work out. Again, it would be divided up amongst the boxes. So they would still get their 12,570 tax-free, the 37,700 basic rate. The rest would be a higher rate and nothing an additional rate. So they would have paid £37,488. Still the marginal rate would be 40%. And their average rate for the year would have been 29.95%. But tapering is a thing. So what happens in reality is, again, their income is divided up, but they get nothing in the personal allowance box. So they still get their 37,700 in the basic rate. Everything else goes into the higher rate. Again, nothing goes into the additional rate. So they end up paying tax of £42,516. Their marginal rate is 40%. Their average rate has jumped up to 33.97%. So that's where we get the 60% figure. So their gross income increased from £100,000 to £125,140. Their income tax jumped from £27,432 to £42,516. So £25,140 extra income cost them £15,084 in extra tax. £15,084 is 60% of £25,140. So effectively they got £1 less taxed at 0%, and that £1 was moved into their 40% band. So the effect is that £1 was taxed at 60%. It's a 60% tax trap. Now it's a little bit different in Scotland. In Scotland, the tax trap is actually 67.5%. Somebody earning 125,140 in Scotland versus the rest of the UK, they end up with a marginal rate of 45% and they end up paying 38.16% average tax. So just to summarise the Scottish figures, £100,000 earner would pay 30,778. The marginal rate would be 5%. That's just how their figures break down. As you can see, they have many more boxes. So they have the starter rate, the basic rate, the intermediate rate, the higher rate, the advanced rate, and the additional rate. And if we go to somebody earning the 125,140, because the tapering works exactly the same in Scotland, it's earnings over 100,000. Their tax jumps up to 47,747, jumping up the average rate to 38.16. And again, the 67.5% figure just comes from dividing the extra tax by the amount extra earned. So I'm hoping that our maths is fairly clear. It does get a lot of people confused, mainly because people think that we're on an average taxation system when we're not. So when we talk to people that are in this tax bracket about what they can do, people are often quite resentful of it. They talk about how it's even worse when they have national insurance to pay too. And obviously it is quite demotivating when you get an extra £25,000 in earnings and you don't even get half of it. But there is an opportunity to get more funds into your benefits without really feeling it as much in your pocket because so much was being taken off in the first place. So there are a few different routes that we can use to avoid the 60% tax trap, but they all come down to lowering your taxable income ultimately. So pensions are normally the first thing people think of, but there's also work benefits. There's making your savings tax efficient, and there is charitable giving. So pensions is the simplest and often the most effective option. So there's two different ways that you can get your pension through work. or personally. So you have salary exchange and net pay pension. In both these scenarios, the money for your pension is taken from your salary before it ever hits the taxation system. So there's never any relief to claim or anything like that. So that's the simplest system. The other system is what's called a relief at source, where the company will take your contributions after you've been taxed. And it works the same way as if you were making a personal pension contribution. So we'll look at both of them and how they would work. So if somebody who was on a salary exchange and net pay pension paid in £25,140 into their pension, they'd immediately save the tax of £15,084, and it all gone into the pension instead. And they end up reducing their take-home pay by about £10,056. So to get 25 grand in their pension, it costs them 10 grand in take-home pay. Now, obviously, if we're talking about a workplace pension, you'll usually make a national insurance saving too. So actually, the take-home pay won't be reduced as much as that. And obviously, if the employer matches or does pass along NI via salary exchange, the amount going in your pension could be significantly higher than that. But the thing about pensions to remember is, put money in a pension, it's meant for your retirement. It's locked away until you're 55, with proposals for that to go up to 57 from 2028. So something to think about there if you were going down the pensions route. But facing retirement is the biggest financial challenge most people will ever deal with. So you rarely regret having more money in your pension than you really wanted. Now, the other system is relief at source or personal pensions, and the logistics of this works a little bit differently. So you would make a personal or payroll contribution totaling $20,112. I should say, in these examples, we're assuming somebody's earned exactly $125,140 and they're trying to get themselves down to 100 grand. Obviously, that's rarely exactly the case. So it's just, but the principle's the same for getting yourself down as low as you can. The pension scheme will automatically claim back the instant tax relief of $5,028, making a total pension of $25,140. Then you would need to complete a self-assessment. When you confirm your contributions and the income that you've had for the year, the system basically takes all the pension contributions off your income, so brings your income down to 100,000 in this scenario. So the tax bill will be recalculated by giving you back your tax code, your personal allowance, and the higher rate tax relief, and you would receive a refund by cheque of £10,056. Sometimes they might ask to adjust your tax code if you're a particularly high earner, depending on which is most efficient for you, but you can ask for the money straight back, and that is generally the preferred route for the Inland Revenue themselves. HMRC. Now, work benefits. You are allowed to have salary exchange schemes. You should have a look at your HR system wherever you work to find out what's available to you. So basically, this is essentially swapping your salary for something else. Now, if you're a contractor or somebody who is a director who perhaps operates without a contract and therefore can negotiate their salary every time, it's fairly simple to say, I want to be paid less and put this in my pension instead as a company contribution. But for most people, most employees, you'll have to engage with the work benefit system to work out what you can and what you can't do. So pension, we've already discussed that. That's the simplest option. It's the one HMRC, never have any issues with at the moment. Obviously, we've got a new government, things might change. So that's the most straightforward one. But there are childcare things you can get through salary exchange, depending on whether your employer supports it or not. So you can get vouchers for childcare. You can get workplace. If your workplace has a nursery or a creche or some association with them, you can pay for those via salary exchange. And it's always assuming your employer supports them, and these things will normally also save you national insurance. Lots of employers operate schemes on salary exchange for healthcare, private medical insurance, scans, lots of other different things that you can get that are available via salary exchange, which means it comes off your salary before it ever hits the tax system, so you end up with a lower salary on paper. Training, lots of employers can support you getting further education, degrees and things like that if they're relevant to your occupation, and they can be funded by salary exchange. Technology, again, there is salary exchange schemes available for technology, for purchase of mobile phones, laptops and other things. Cycle to work schemes allow you to buy bikes. You don't actually have to be for getting to work. You can get them for your kids or whatever. Again, these are taken from your salary before you pay for your before they hit the tax system, so they help to bring your income down. And then the car schemes. The NHS famously offers a salary exchange car scheme, which I had to look at a bit more closely for a client this week. But some companies can even offer you parking schemes to allow you to park closer to work, where they pay for your annual permit on a salary exchange basis. But the thing to be aware of with work benefits is sometimes they will trigger a benefits in kind tax. You would see that in your P11D, but most work HR systems will have a way of letting you know roughly what that's going to be, and that itself would make an adjustment on your personal allowance. So you need to take that into account when you're doing your maths. So it's important to watch, and sometimes it's worth looking at things a couple of months before the end of the tax year, so that if you need to, you could make a personal contribution or change your workplace pension contributions to make up for any benefits in kind that you might have received. Then we have tax efficient investments, which seems like an odd one, but particularly at the moment when you are actually getting some interest on your savings, interest you receive from savings and dividends, though they might not be taxed at the same rate as your normal income is, they are added to your income as part of the calculation of whether you get or keep your personal allowance. It's a little bit more complicated, but there's some basic principles to follow. Use ISAs if you're not using your allowance. They're tax-free, so they'll make sure that they don't interfere with your taxable income. National Savings and Investments offer several tax-free accounts. If you don't know what NS&I is, it's a government-owned savings bank. It's not really a bank, but it's the government's own savings organisation, and they offer several tax-free accounts. Offset mortgages. If you do have significant savings, you can consider using an offset mortgage. Essentially, with an offset mortgage, you have a savings account with the bank that you have your mortgage with. They pay you no interest on the savings account, so it doesn't affect your earnings for the year, but they reduce the interest they charge you on your mortgage instead. So you get the benefit of having the savings and having a return from them without actually receiving any income, and therefore not affecting your tax position. And if you are married or in a civil partnership and one of you is earning significantly less than the other, move the savings and investments into that person's name where you can, and that will allow them to be outside of your tax return. Now, the caveat there, if you're not married, you might want to think twice about that, because if you split up, there is no way for you to recover the money that you put into somebody else's name. If you are married, it doesn't really matter whose name the money is in, because if you divorce, it'll all be taken into account when the settlement's done anyway. Now, charitable giving. In order to use charitable giving to reduce your outgoings, reduce your income, you need to tick the gift aid box and make the donations in your own name. So, essentially, if you make a donation or total donations totaling, and obviously we're trying to get the maximum here, so we're 125,140, trying to get down to 100k, totaling £20,112 in the year, and you tick the gift aid box. The charity claims basic relief, so they get topped up to 25,140. You need to complete a self-assessment, confirming your donations and your income. So your income will get calculated back down to the 100 grand. So again, they will retrospectively adjust your tax code, and you'll receive a refund of higher relief and what you missed out on because of the personal allowance having been removed throughout the year. So you'll receive a tax refund of £10,056. Now, charitable givings I want to think about in our day-to-day lives. It just occurred to me this morning, and it hadn't really crossed my mind, and then I told my accountant, but my kids are both in the Scouts. When you pay the fees to the Scouts, because the Scouts is a charity, for example, they ask you to do a gift aid declaration, which we've done. So the Scouts can claim back a little bit more from their subs from the government. I can't put those payments on my tax return. It doesn't affect the Scouts anyway. They still get their rebate, but I get the higher tax relief on their premiums, which will have to bring my income down. And even if you donate to a charity shop, as if you fill in the forms rather than just dumping your stuff at the counter and running away, they will regularly email or write to you with a valuation on the value of your donations as and when your goods are sold. So I get regular emails from the charity shop we drop off things, that's just telling me what my total gift aid donation's been for the year, and give that to my accountant, and he can claim the hire relief on it. It's not a lot, but it all helps. So that's it, really. I've tried to keep it as simple as possible. So it was a fairly quick run through. So if you have any questions, I'll give you a minute to hit the Q&A box, and I'll answer them straight away. And I'll say while anybody might be typing a question, there's another webinar scheduled in for the end of September. We're trying to move them to one a month, I think. But there's no actual subject there for it at the moment. So if you have any suggestions, feel free to pass them along. When we close this webinar, you'll ultimately be redirected to a survey page just for a little bit of feedback on the content, whether you understood that sort of thing. And at the bottom, there's a question. If you have any subjects that you want covered, then you pop it in there and we'll consider it and we'll update the subject soon. So first question in, a little bit off subject, but can your partner inherit your pension if you die? Depends on when you die and what you're doing with your pension. So if you're still working and accumulating pension, so you're still in the workplace, then yes. As long as you've declared them as the person you want to receive it, or you're legally married, and there's no declaration, then they should be able to inherit the pension and use it as if it was their own. Often be able to get it free, tax-free. If you've already retired, it depends on what you've done with it. So if you've converted it to an annuity, it depends on the terms of the annuity. If you're using flexible access drawdown, then yeah, they'll just inherit the pot of money. There's an So usually we get a lot of more questions on this, but hopefully I've covered things fairly straightforward about the maths, which is the bit that throws people up. But essentially, something people often ask as well is if we're earning much more than 125,140, is there a period where it starts to bring our average tax rate down? No, there isn't, essentially, because even in the 60% tax trap, your average tax rate is below your marginal rate, and therefore any more you earn will still just raise your average tax rate up. So anything you want to pay in will help to bring things down. The trap is just the bit about where you're being particularly penalised on that particular tranche of earnings, really, and what you can do about it. And for a lot of people, the main benefit is because you're being so heavily penalised, you don't really feel it in your pocket when you try to do other things with the money. So if there are no other questions, I will leave it there. And as I said, you will get redirected at the end to a survey. Really grateful if you could take 2 minutes and fill that in. And past webinars, some of them are on our YouTube channel. So feel free to go have a look at that if you wish. They won't always stay there forever. Recording for today will go out at the end of today by the time it's downloaded and uploaded, and I've cut off the bit at the beginning when I'm checking the microphones and stuff. Okay, so thanks very much for your time, and again, sorry that we had to delay this one by a week. Take care.